Hello and welcome to this episode of TM tutorial series of videos. Today's topic is operating leverage. Now, leverage means using something to maximum benefit. That is using something to get the maximum benefit. We have heard the term leverage of a machine, which is very common term in mechanical engineering, which means exertion of a huge force with the use of a small machine or small lever. That means using something to the maximum benefit. The same thing happens to business finance. And here benefit means profit. So the firm is using something to amplify its profit. That is called leverage in finance. Right? Now leverage can be of two types. One is operating leverage and the other is financial leverage. And we can derive our new leverage by combining operating leverage and financial leverage. So leverage can be of two types. One is operating leverage and another is financial leverage. And you can combine these two to get combined leverage. We will learn financial leverage and combined leverage in some other video, and this video is focused on operating leverage. Now, operating leverage means operating risk. At the same time, opportunity for the firm to amplify profit, that is, to increase profit in a greater proportion than increase in sales. That is possible only if there is fixed cost in the cost structure of the firm. If the firm has no fixed cost in the cost structure, then the firm has no operating leverage. Okay, if only variable cost is there, then the firm cannot have any operating leverage. So, what is the measure of operating leverage? The measure of operating leverage, that is degree of operating leverage, degree of operating leverage is equal to percentage change in profit divided by percentage change in sales. Now this profit is what? EBIT, earning before interest and tax. So this is equal to delta EBIT divided by EBIT whole divided by delta S by S. Delta EBIT change in EBIT and delta S is equal to change in sales, right? Delta EBIT by EBIT divided by delta S by S. This is equal to delta EBIT by EBIT into S by delta S. Okay. This is equal to delta C by EBIT into S by delta S. This is equal to delta C by delta S into S by EBIT. Okay, this is equal to delta C by delta S is equal to C by S, that is change in contribution by change in sales should be, would be equal to C by S, contribution by sales. So C by S into S by EBIT. S cancels out, so what remains? C by EBIT. This is degree of operating leverage, that is contribution by divided by earning before interest and tax. Okay, so operating leverage is basically operating risk for the firm. At the same time, the opportunity for the firm to use the fixed cost to amplify the profit. If there is no fixed cost, then profit cannot change in a greater proportion than the proportion of change in sales. Correct? Now, we shall take a numerical example to see how operating leverage works, that is how operating leverage impacts profits at different levels of volume of production. So I am erasing this part, right? Yeah, I am erasing this part. Let there be two firms, firm X and firm Y. Okay, there are two firms X and Y. Here we measure units. Figures in 1000. 20, that is 20,000. 30, that is 30,000. 40, 50, 60, 70 and 80. Okay. Now for firm X, sales price 8, variable cost 6 and fixed cost say 80,000. These are per unit. This is per unit. For firm Y, sales price remains same, 8 per unit. Variable cost we see say 4 per unit and fixed cost 200,000. Here we measure sales, variable cost, fixed cost, total cost profit. Yeah, same thing here, sales, variable cost, fixed cost, total cost, profit. Now watch carefully. For 20,000 units, sales of firm X will be 8 into 20,000, that is 1,60,000, that is 160. For 30,000, it will be 8 into 30, 240. Here it will be 320. Here it will be 400, be 480, this will be 560, and this will be 640, right? Figures are in 1000. What will be the variable cost? 6 per unit. 6 into 20,000, 120, 180, 240, 300, 360, 420, and 480. What is the fixed cost? 80,000 per annum fixed. 80, 80, 80, 80, 80, 80, and 80. So total cost becomes 120 but plus 80, that is 200. This is 260. This is 320. This is 380. This is 440. This is 500, and this is 530. Okay, 120 plus 80 is 200. 180 plus 80, 260. 240 plus 80, 320. 300 plus 80, 380. 360 plus 80, 440. 420 plus 80, 500. And 480 plus 80 is equal to 530. Sorry, 560. Okay. So what is the profit? This minus this. So this is minus 40. This is minus 20. This is 0. This is plus 20. This is plus 40. This is plus 60. And this is plus 80. Okay. Right? Now let's see what is happening in case of firm Y. Units of sales remain same. Sales price remains same. Only there is change in variable cost and fixed cost. So for firm Y, what will be the sales? Same. 160, 240, 320, 400, 480, 560, and finally 640. The variable cost per unit for firm Y is 4. So 4 into 20,000, that is 80, 120, 160, 200, 240, 280 and 320. Figures are in thousand, right? Yeah. Now what is the fixed cost? 2 lakh. That is 200, 200, 200, 200, 200, 200 and 200. Right? Yeah. Now what is total cost? 80 plus 200, that is 280. 120 plus 200, that is 320. 320. This should be, 160, this should be 160. 160 plus 200, this will be 360. 200 plus 200, so 400. 200 plus 240, 440. 200 plus 280, that is 480. And 200 plus 320, that is 520. Okay? Variable cost per unit is rupees 4. So 4 into 20, 80, 4 into 30, 120, 4 into 40, 160, 4 into 50, 200, 4 into 60, 240, 4 into 70, 280, 4 into 80, 320. Fixed cost remains 200, that is figures in thousand. 80 plus 200 is 280. 200 plus 120 is 320. 200 plus 160, that is 360. 200 plus 200, 400. 200 plus 240 is 440. 200 plus 280, 480. 200 plus 320 is 520. Now you see the profit. This is sales, this is total cost. So 160 minus 180, that means minus 120. $240 minus 320, that is minus 80. 320 minus 360, that means minus 40. 400, 400, it is 0. Here 480 minus 440, that is plus 40. Here 560 minus 480, that is plus 80. 640 minus 520, that is plus 120. Now carefully watch the table. Carefully watch the table. Firm X is breaking even at, the firm X is breaking even at 40,000 units. Correct? Firm X is breaking even at 40,000 units. That is, the firm is reaching the point where the firm is neither earning any profit nor incurring any loss. And in case of firm Y, you see the firm is breaking even at 50 units. 50 units. That means Farm X is reaching break-even point earlier than Farm Y. Farm X is reaching break-even point earlier than Farm Y. This is due to impact of fixed cost. This is 80,000. In Farm Y's case, it is 2 lakh. So it has to cover more fixed expenses compared to Farm X. Secondly, you see, sales are increasing from 20 to 30 to 40 to 50 to 60 to 70 to 80, so on, for both the farms. Correct? Now you see, after break-even, Farm X is earning profit of 20,000, whereas after break-even, Farm Y is earning profit of 40,000. Okay. So, what is happening? Sorry. For every incremental production of number of units, 60, 70, 80 and so on, Farm Y is earning more and more profits compared to Farm X. This means this farm Y has more operating leverage than this farm. That is, DOL of Farm Y is more than DOL of Farm X. Right? Yeah. Now, if we draw diagrams for these two farms, let us see what becomes the diagrammatic representation. So I am erasing this part. Also, I am not going to draw the diagram up to the scale. But the idea of drawing the graph is to convey the theme of the whole thing. This is Farm X. This is Farm Y. Output on x-axis and on y-axis, cost and revenue. Cost and revenue. Now Farm X has relatively lower fixed cost, so let the fixed cost line start from here. Farm Y has much higher fixed cost, let it start from here. Both of them have the same sales price, so gradient of the sales price line will be same. So this will be sales lines of the two farms will be parallel to each other. This is not become parallel. I have to make it parallel. Why parallel? Because both farms are selling the products at same price per unit. Okay. Now for Farm X, variable cost is higher compared to Farm Y. So variable cost line will be like this. And for farm Y, variable cost is higher. It will be like this, isn't it? Yeah. This will be the variable cost, and here this is the variable cost. This is VC for this farm, this is VC for this farm, and this is FC, this is TC, and this is S. TC, sorry, S and TC. Correct? Now you see, this is the break-even point where total cost line and sales line intersect. Okay. You see, this is BEP units, and here this is BEP units. The farm X, having lower fixed cost, reaches BEP at an earlier stage relative to farm Y, because farm X has more fixed cost compared to fixed cost of farm Y, and farm X has lower fixed cost compared to fixed cost of farm Y, and farm X has more variable cost compared to that of farm Y. Now, as output grows, we have seen successive profit will be bigger for this farm. Okay, the difference between sales line and total cost line, this part will be bigger and bigger in case of farm Y. This part, sales by total cost, this will be bigger and bigger for farm Y relative to farm X, because farm Y has more degree of operating leverage than farm X has. Correct? So operating leverage is basically ability of the farm to use the fixed cost to amplify the profit, so that the profit increases at a greater proportion than the increase in sales. When a farm uses only variable cost, that is, the farm does not incur any fixed cost, in that case the farm won't have any operating leverage. That means the farm has no opportunity to increase profit in a greater proportion than increasing sales. But the farm which has fixed cost can use the fixed cost to amplify the profit. That means the farm can use the fixed cost to increase the profit in a greater proportion than increase in sales. So this happens in the good time. When there is a good time in business and optimistic environment is everywhere, then this operating leverage charges up the profit. Profit grows and grows and grows and goes on growing. But in case of a recession or economic downturn, the farm suffers huge loss. Why? Because of huge cash outflows due to huge investment in plant, machinery and technology. As we have seen during the COVID period, that airline industry suffered huge loss. The companies in the airline industry suffered huge loss due to their huge cash outflows to maintain the plant and machinery and technologies operative. So more a farm becomes capital intensive, more is the impact of fixed cost on the cost structure. Less capital intensive farm has less risk because those farms use relatively lower amount of fixed cost, so that the farms don't have to incur huge cash outflows where there is economic downturn. So operating leverage has a benefit as well as a risk. The benefit happens in the good times when the farm is able to increase the profit in a greater proportion than increase in sales, and the reverse happens in bad times when losses incurred by the farm increases in a greater proportion than fall in sales. Okay, yeah, that's it. So I believe you have enjoyed this video. Please be in touch through comments, through likes, and by subscribing our channel. Your subscription, your likes and your comments will enrich us, will encourage us, will motivate us to provide more useful, meaningful and more purpose specific videos. Yeah, that's right. Okay, thank you for watching this video. Goodbye, stay well.